In this question, the question tells us, from the balance sheet of ABC Limited, prepare the statement showing changes in working capital, treating proposed dividend as current liability and provision for taxation as non-current liability. So here in this question, they have given us some adjustments, and based on those adjustments, we will have to go about treating the items. Okay, so based on those, we will have to go about treating those items. So let's look at it. What they're telling us is that we have to treat working capital we have to take proposed dividend as a current liability, and then provision for taxation as non-current liability. Now, proposed dividend and provision for taxation, these two items, there is an exception. You can either treat it as current liability or non-current liability. You have an option of either treating it as current liability or non-current liability. Both these items, that is proposed dividend and provision for taxation, both these items, you have an option of treating it either as current liability or non-current liability. So here what they have done is they're asking us to treat proposed dividend as current liability, provision for taxation as non-current liability. So with that note, let's start off with this question. Let's go about with the preparation of the schedule showing changes in working capital. I've got the format of the schedule showing changes in working capital ready over here. Let's populate it one by one. Year 1 is 2005. Year 2 is 2006. And let's look at it. And what are our current assets? So we have short-term deposit. What do you mean by short-term deposit? Short-term deposit is a deposit that you would be opening for a short period of time. So it could be 1 month, it could be 2 months, but this is always treated as a current asset. Then we have 2006, we have 9 lakh. So here, let's look at how does it impact? Your working capital has increased. Next item is inventory. Inventory is nothing but your stores. Inventory is nothing but your stores. Inventory is 8 lakh, and here it is 9,40,000. Okay, then we have debtors. Here it is 13 lakh. Here it's 13,40,000, and here it is 10,60,000. Okay, next what we have is cash at bank. Cash at bank is 4,40,000. And here it is 6,60,000. Here it is 6,60,000. Then next what we have is prepaid expenses. So prepaid expenses is 40,000 and then 20,000. Now let's look at what impact does this have. Here inventory, what has happened with inventory? Inventory has increased, and there's an increase in working capital by 1,40,000. What has happened with debtors? Debtors has reduced, and debtors has reduced by from 13,40,000, it has come down to 10,60,000. So your working capital has reduced by 2,80,000. Here what has happened? Cash at bank has increased, and it has increased by 2,20,000. And here in the case of prepaid expenses, from 40,000 it has reduced to 20,000, which means here it has decreased by 20,000. Now let's calculate the total. Okay, let's add up this, and let's add up the total, and let's see how much is the total current asset. Total current asset is 32,20,000, and for 2006 it is 35,80,000. Now let's move on to the liabilities. What are the liabilities that we have in this question? So we have share capital, we have debenture, we have profit and loss. All these are not current liabilities. General reserve, that is also not a current liability. Then we have creditor. So creditor is a current liability, and let's look at the value of creditor. Creditor, here it is 9,80,000, and here it is 11,20,000. Next one, now what they're asking us to do is they're asking us to treat proposed dividend as a current liability. Proposed dividend, I'm treating it as a current liability. So proposed dividend here it is 2,40,000. Here it is 3,60,000. Okay, 2,40,000, 3,60,000. Now what has happened with proposed dividend? Proposed dividend has increased. Okay, proposed dividend has increased from 2,40,000, it has increased to 3,60,000. So when proposed dividend increases, what will happen to your working capital? Working capital will reduce by 1,20,000. Okay, it will reduce by 1,20,000. So that has also been, let's total this up. This will be 12,20,000, and here it will be 14,80,000. Now let's look at the working capital. Now, how do we calculate working capital? Working capital is current asset minus current liability. Current asset minus current liability. For year one, it is 20,000. Okay, so for year one, it is 20,000. Similarly, let's calculate for 2006. 2006, it is 21,000. Okay, it is 21,000. So 2005 working capital is 20,000, 20 lakh. Sorry, I think I made a mistake. It is 20,000. It is 21,000. I think I mentioned that as 20. Okay, so okay, so now let's look at how has this impacted our working capital. What has happened with working capital? First year working capital was 20 lakh. Here it is 21 lakh. So what has happened with working capital? Working capital has increased. So increase in working capital. Okay, there has been an increase in working capital. How much is the working capital increased by? Working capital has increased by 1 lakh. So how much is your total working cap between across the 2 years? It is 2 lakh. Here it is 21 lakh. Here also it is 21 lakh. So with that note, dear students, we have completed the preparation of schedule showing changes in working capital.